Our speakers today are Jay Sherrill and Henry Montag. Henry, the floor is yours.
Thank you. Good afternoon. My name is Henry Montag, and I'd like to thank everyone on the call for joining us. I'd also like to thank Carol Burns, Steve Gallagher, Dane, and Tiffany for arranging and for setting everything up this afternoon. So this afternoon, we're going to be talking about the Secure Act, a law that basically affects every American's retirement savings and calls for everyone to adjust and revise their plans, particularly those that intended to use the IRA, their IRAs, as wealth transfer to the next generation, as they'll now generate significant new tax liabilities for their beneficiaries. Now, life insurance has become the generally accepted best practice to relieve that future tax liability for their beneficiaries. But what effects does the COVID pandemic have on the various types of insurances? And what's the best strategy to offset the additional tax liability? Well, first, Jay will discuss and give us some of the basic tenets of the Secure Act and provide us with some interesting legal, useful strategies. That'll go on for about 25 minutes. Then I'll come back and discuss the pandemic's effect on the various types of life insurances, including the good, the bad, and the ugly points, as well as some issues and strategies that you and your clients will be glad that you're aware of. And that'll go on for about 20-25 minutes. Lastly, we'll conclude with 10 minutes at least of questions from the both of us. So please don't forget to download our handout materials. Now it's my pleasure to introduce Jay Sherrill, an attorney that I've heard speak and is extremely knowledgeable regarding this new law. Jay, the floor is yours.
Thank you. Thank you, Henry. Thank you to the New York State Bar Association for inviting me today. Thank you, Henry, for arranging this. And also, thank you to the senior lawyers section. I'm honored to be here today.
What I'm going to be speaking of, and again, it's just pretty clear that the Secure Act had individuals lose an awful lot of the potential tax benefits that they had by being able to stretch their IRA distributions out over normal life expectancy. Today, they're limited to the 10-year period. It's pretty much accepted that the best way to do that is through life insurance, but the question then becomes what type. And we'll be discussing the various alternatives, some of the good, the bad, and the ugly, and also spending a little bit of time on the subject of life settlements, because there are unfortunately an awful lot of people that are cash strapped, excuse me, cash strapped right now, and they could use some of the benefits of their death benefit of life insurance policies today for various reasons, rather than waiting until they hit their beneficiaries. So different policies provide different options.
Henry.
Life insurance will certainly increase their what's known as COIs, cost of insurance, as a result of the COVID-19 impact on the returns. Keeping in mind, the life insurance companies are really just like banks, and they make the majority of their money, excuse me, on the returns. And needless to say, when returns are reduced down to 0% or 0.25%, it significantly impacts the life insurance returns as we know it today.
Henry.
The point is that all life insurance always has to be actively managed and to be on top of it to be able to maintain. And we'll also talk about some of the best strategies, which again might be something that some of you may or may not be aware of. There are two different types of life insurances. There's the guaranteed type and there's the non-guaranteed type. Most common type of life insurance available today, approximately 55%, is of a universal nature, and it's basically of a non-guaranteed universal nature. And what happens there is that the premium that the insurance company provides us remains constant. The billed premium remains constant. The death benefit remains constant. The only variable is the duration of how long that coverage actually lasts. And the duration is reduced in time due to the lower rates and the lower earnings of the insurance company. Now, basically, the owner should have increased the premium to make up for those reduced rates, but usually wasn't aware and usually didn't. Again, as I mentioned, roughly 55% of coverage today is of a non-guaranteed universal life insurance. And the insurers benefit when coverage expires early. Next slide, please. This is page 3 of a 6-page some annual summary. And if you look down at the bottom where it says important notice on the bottom of page 3 in small print, it says changes in interest rates may impact the insurance coverage. And basically they're telling us an important notice on the bottom of page 3 in tiny print that basically no one reads. Next print, please. This was a quote from the Wall Street Journal, and basically what it says is that the senior writer for the Wall Street Journal on insurance matters discusses the fact that most people are absolutely unfamiliar with their insurance policies, are unaware that they should be kept well funded, and as a result, many of those life insurance policies are expiring prematurely. Next slide, please. It's not just the individuals or the press that's stating this. This is the Insurance Marketplace Standard Association, and this is a fellow named Donald Walters, who is general counsel for the life insurance industry. They're saying that while insurers have not publicized the issue, there is certainly a growing concern in the industry about lapsing universal life policies. Next slide, please. Now, on the other end of the spectrum is something called a guaranteed universal life policies. Guaranteed policies, the premium is sufficient. It's set at the time that the individual purchases the policy. And it's also the least expensive way to purchase permanent coverage. It doesn't provide any accumulation. So at the end of 5 or 10 or 15 years, there will not be any accumulated money to be able to take out, but you will provide maximum coverage, and that maximum coverage is guaranteed. The guaranteed policy is not affected by the pandemic, and it is suitable for the stretch IRAs or offset planning. Next is something that's known as the indexed universal policy. That is based on a specific return on a sector in the stock market. Now, what they do is they will set a limit on how much of the return. In other words, if there's a 15% return, they might set a limit that you can only achieve the first 5% or 6% or 7% on that total return. Now, you have that in exchange for a floor on losses. The returns for anyone who had a indexed universal policy was not affected by this stock decline that we've recently experienced, but the fees will continue to be deducted. And when there are negative years, as there probably will be this year, while there are no losses in the actual stock market, in the actual returns, those fees will continue to be deducted, and those fees will eat up the death benefit, and that death benefit is not guaranteed. As a result, this is affected by the pandemic and is not the right type of a policy for an individual looking for a premium offset. The next type of policy is something that's known as a variable life insurance policy. There, the coverage is based 100% on the stock market returns. There are no guarantees. So if an individual purchases a variable policy because he or she is promised the fact that there will be a tremendous V-shaped recovery, and that V-shaped recovery turns into a W-shaped recovery or a U-shaped recovery, or anything where the market goes back down, there are no guarantees, and the coverage can increase or decrease. Again, any type of future decrease on that marketplace will affect the duration of that coverage. Again, this is a policy that's affected by the pandemic and not suitable for any sort of Secure Act offset planning. One of the original types of policies was a whole life policy. A whole life policy is guaranteed for the balance of the insured's life. The policy accumulates cash value, and usually by the time an individual is in their 80s or 90s, the individual is being paid back with pretty much their own money. It provides the least amount of death benefit and is also the most costly type of coverage. Although the facts are what they are, the duration of coverage is not affected by the pandemic, and it is suitable for Secure Act offset planning. However, I would not recommend this simply because you're paying the most money for the least amount of coverage, And when your beneficiaries eventually receive the money, depending on date of death, they're going to be paid back with a significant amount of their own money through the accumulated cash value. One of the most prevalent and, as far as I'm concerned, one of the best ways to purchase a life insurance policy. And again, let me just take a second just to say that an individual can purchase a policy that pays when an individual dies, or an individual can consider purchasing what's known as a second to die policy, which won't pay out the death benefit till the death of the second individual. And if you think about it, for the inherited IRA, this is exactly when the money needs to be available to be able to offset the next generation's future tax liability. This type of strategy is available with all types of policy, with the exception of term insurance. The cost is significantly less with a second to die policy. For example, cost of a $500,000 guaranteed policy for an individual to age 96. Use the example of a male age 78. The individual cost of $500,000 would be $31,700. Assuming his or her wife is age 74, that same cost for that $500,000 guaranteed death benefit to age 96 is approximately $18,000. However, a second to die policy, the cost for both would be approximately $14,700, significantly less than paying for the insurance for that individual age 78 or even for his wife. Two types of insurances which were the old favorites: whole life insurance and term life insurance. Term life insurance is the least expensive cost for a maximum death benefit. It does not accumulate any cash value, and it can be guaranteed for 1, 5, 10, 15, 25, or even 30 years. But all term insurance ends between age 80 and 82. Keep in mind, only 2% of term insurance policies are ever paid out. As a result, this is not suitable for the Secure Act offset planning, although it appears to be the least expensive way to purchase life insurance. But the life insurance has to be available for the individual and has to be there after the individual passes away, rather than the term insurance expiring before the individual passes away, as does happen with basic term insurance. Now, I think the example that Jay gave with annuities is one of the best ways of using the accumulated money in a IRA, even better yet, in a IRA Roth conversion, as Jay explained, because of the current decline in the stock market. This will provide less in the way of taxes being paid initially and more in the way of money available to be able to be used to buy a death benefit. Now, annuities, you should be aware that the Secure Act now allows annuities to be used in qualified plans. Heretofore, that was not the case. Now, annuities can accumulate tax deferred annuities. And let me just mention that there are two types of an annuity. One is the single premium immediate annuity, which is the example that Jay provided. And then there's also something called a single premium deferred annuity, a good way to accumulate funds on a guaranteed basis. And again, in terms of where and what the stock market has done, somebody looking at a 3 to 5% guaranteed return based on how long they want that guarantee to last for is not a bad alternative to be able to be considered for diversifying clients' portfolio. Again, annuities can also be used to pay for long-term care costs. And again, just that single premium immediate annuity is an ideal way to pay for an individual's insurance premium on an ongoing basis to guarantee that both the premium as well as the death benefit will be there whenever the individual passes away. For those of us that are calling in on telephone rather than viewing the actual presentation, the MCLE verification code is letter R. Again, the MCLE verification code for those of us on the telephone is the letter R. Now, if there's a problem with an individual's policy, there are basically four options. The individual can either reduce the death benefit, the individual can pay a higher premium, or if the individual is healthy enough, he or she can obtain perhaps a new guaranteed contract if in fact they are able to based on health. The fourth option is something called a life settlement, and the fifth option is a combination of the above. If life insurance is either no longer affordable due to the pandemic, or if people need the cash immediately to pay for other costs, or if life insurance is deemed to no longer be needed to pay for these state taxes, again, as Jay explained, the sunset provision kicks in 2025, and the tax exclusion goes from an $11 million per individual back down to approximately a $5 million estate tax exclusion. So many people, for whatever reasons, may feel that, well, let me just go ahead and get rid of some of my taxes, some of my life insurance. And many people will use two options to reduce or liquidate their current existing life insurance policies. They will either go back to the insurance company and surrender the policy for its cash value back to the insurance company, or they'll just use up whatever cash value is there and let the policy just continue paying for itself, and eventually that cash value will run out, and eventually that policy will lapse. The life insurance option provides a significantly larger return. For example, a male age 82 with a $3.5 million death benefit with $1.2 million in cash value, if that individual decides to forego his $3.5 million life insurance policy, he can go back to the insurance company and receive $1.2 million in cash value, or he or she can go to the secondary market through a licensed life insurance settlement broker and receive $1,875,000. This was a previous case that I just concluded. So these are real numbers. Unfortunately, many advisors and the majority of clients are unfamiliar with this. And the reason that they're unfamiliar with this is due to a case called Larry Grill versus Lincoln National. It's a situation where the insurance industry basically has placed a gag order on the individual agents because the insurance companies, as I explained earlier, like when policies expire. And the gag order basically said that the insurance agent nor the insurance company did not have a duty to disclose this option. I'll talk more about that in a moment when we get to the current regulations that were just passed regarding the duty to disclose. Next slide, please. The requirements for life settlement: individuals should be at least age 70. The minimum death benefit is approximately $100,000. The individual should have some medical issues, and all types of policies, including a term policy, can qualify for life settlement. And again, I think the most important aspect there is to select an independent life settlement broker to be able to go into the secondary market for you. Next slide, please. Very quickly, I know that there was recently a program on the subject of business interruption insurance, and just for those that might not have been on that call, many people who were significantly affected by the existing pandemic with businesses closed, many of those people had a business interruption insurance policies. Unfortunately, they did not find out until after they went to collect that all of those business interruption policies exclude a virus pandemic. And this occurred as a result of the SARS virus in 2008, where insurance industry just realized that it could not afford to pay the costs for business interruption in the result of a worldwide pandemic. More on that as individual attorneys are putting together all sorts of class actions and hoping that the government will intercede and help the insurance industry come up with a way to pay for that business interruption insurance. Next slide, please. Again, embarrassed to say that it wasn't until February of 2020 that the insurance industry first regulated through Regulation 187 that a individual agent has the duty to inform his or her clients. Although there is no obligation for providing post-sale services, in other words, the obligation is still up to the individual to maintain and to actively manage their policy. It is not the obligation of the insurance company, nor of the agent. It's the obligation of the owner of that policy or the trustee. Individual does not have to provide the least expensive product to the individual, but the new rule does require full written disclosure of the risks and full disclosure of compensation of the agent or broker providing the transaction. Many of these items that I've mentioned today regarding the idea of life insurance not living on forever and life insurance expiring before the individual that it's insuring are covered in this American Bar Association book, which I co-authored back in 2018. Next slide, please. For purposes of time, I'm going to slip by this, but if anyone is interested, if people download our handouts and if anyone requests this information, I'll be more than happy to send that to you or include that. Basically, we just are running out of time, and I want to leave some time for the open-ended questions. So again, thank you for your participation, and please submit your MCLE verification forms back to the email that was mailed from.